Have you ever really looked at the money in your wallet? What gives this piece of paper, or these digital numbers on a screen, their value? For most of human history, the answer was simple. It was backed by something real, something tangible. Gold, silver, precious metals. This is the story of money, a story of a silent promise, and a warning we might need to hear today. Let's rewind the clock. Imagine ancient Lydia, around 600 BC. This is where we see the first standardized coins, made from a natural alloy of gold and silver called electrum. The value wasn't arbitrary, it was based on the weight and purity of the metal itself. If you had a coin, you held real wealth in your hand. This idea dominated for centuries. From the Roman denarius to the Spanish dollar, money was metal. It was heavy, reliable, and universally accepted because its intrinsic value was understood by everyone. Then, things started to get more convenient and a bit more complicated. Carrying around bags of heavy coins wasn't always practical. So, people started depositing their gold with trusted goldsmiths, who in return issued paper receipts. These receipts were promises, IOUs that said, you can redeem this paper for a specific amount of gold anytime. And just like that, paper money was born. It worked beautifully because it was backed by a one-to-one promise to the metal sitting in a vault. This was the heart of the gold standard. For a long time, major world currencies were tied to gold. The British pound sterling, and later the US dollar, were anchored to a fixed amount of the yellow metal. This system provided stability. A country couldn't just print money out of thin air. Its currency supply was limited by its gold reserves. This disciplined governments and kept inflation in check. It was a system built on trust, but also on the hard reality of physical metal. But the 20th century brought immense change. World wars, economic depressions. These massive events put incredible strain on the gold standard. Governments needed to fund enormous expenditures, and being tied to gold was restrictive. So, one by one, countries began to sever the link. The final decisive moment came in 1971, as President Richard Nixon announced that the US dollar would no longer be convertible to gold for foreign central banks. This move, known as the Nixon shock, effectively ended the Bretton Woods system and plunged the entire world into a new era, the age of fiat currency. Fiat is a Latin word meaning, let it be done. Fiat money has value simply because a government declares it does, and because we all agree to accept it as a medium of exchange. There's no gold, no silver, no tangible asset backing it. Its value is based entirely on faith and confidence in the government that issues it. This system offers incredible flexibility. Central banks can now manage the economy by adjusting the money supply, printing more to stimulate growth or tightening it to fight inflation. It's a powerful tool, but it also comes with a significant risk. Without the anchor of a physical asset, what stops a government from printing too much money? History is littered with examples of hyperinflation, from the Weimar Republic in Germany to modern-day Venezuela, where trust in fiat currency collapsed, and paper money became virtually worthless. This brings us to today, and a fascinating and perhaps worrying trend. While we're all using fiat currencies, transacting with credit cards and digital apps, what are the world's central banks doing? The very institutions that manage these fiat systems are quietly, but aggressively, buying gold. In recent years, central banks around the globe have been on a gold buying spree, the likes of which we haven't seen in over half a century. Countries like China, Russia, Turkey, and India are adding tons of gold to their reserves every single month. They're not just buying a little, they're stockpiling it at a historic pace. So, we have to ask the question, why? Why are the ultimate financial insiders, the managers of our global monetary system, hedging their bets with the oldest form of money known to man? There are a few compelling reasons. First, diversification. In a world full of geopolitical uncertainty and economic volatility, gold is seen as the ultimate safe haven asset. It has no counterparty risk. Its value doesn't depend on any government's promise or any corporation's solvency. It's an insurance policy against financial chaos. Second, a potential shift in the global order. For decades, the US dollar has been the world's reserve currency. But as other economies rise, there's a growing desire to move away from dollar dominance. By holding gold, countries can increase the credibility of their own currencies and reduce their reliance on the US financial system. It's a strategic move in a global economic chess game. And it's not just gold. Silver, often called poor man's gold, is also seeing a surge in demand. While it's a monetary metal, it also has massive industrial applications, especially in green technologies like solar panels and electric vehicles. This dual demand as both money and a critical industrial commodity makes its future incredibly interesting. So what does this all mean for you and me? It's a metal warning. It is a signal from the world's most powerful financial institutions that they might not have complete faith in the long-term stability of the very fiat system they manage. When the people in charge of the paper money are rushing to buy physical metal, it's probably a good idea to pay attention. This isn't about predicting doom and gloom. It's about understanding the history and the fundamentals of money. For thousands of years, gold and silver have been the ultimate store of value. They have survived empires, wars, and every financial crisis imaginable. Fiat currencies, on the other hand, have a much shorter and more troubled track record. In fact, every fiat currency in history has eventually returned to its intrinsic value, zero. We are living in a grand monetary experiment, an experiment where value is based on collective belief rather than physical reality. The actions of central banks suggest they are preparing for a future where that belief might be tested. Maybe it's time we also thought about what real wealth is and how to preserve it in an uncertain world. The story of money is still being written, and the next chapter could look a lot like the first. Thanks for watching. If you found this journey through the history of money insightful, please hit that like button and subscribe for more deep dives into the forces shaping our world. See you next time. But that lesson assumes central banks retain the ability to raise rates without triggering systemic collapse. During the 1980s, federal debt was manageable. Financial system leverage was limited. Economic growth could absorb high interest rates without systemic breakdown. Today's system operates under different constraints. Federal debt exceeds $33 trillion. Interest payments consume 13% of federal revenue. Corporate debt reaches record levels. Financial institutions' leverage ratios approach PI to 0.8 levels. Economic growth depends on continued low interest rates for sustainability. Raising rates to 1980s levels would trigger immediate debt crisis, corporate bankruptcy waves, financial system collapse, and economic depression that would make the 1930s appear manageable by comparison. Central banks cannot use the 1980s solution because the monetary system has become addicted to low rates for basic functionality. The tool that restored confidence previously would destroy the system entirely if applied today. This is why central banks are buying gold while issuing digital currencies. They understand that current monetary arrangements are temporary, that confidence will eventually require metal backing, that preparation must begin before crisis makes preparation impossible. The pattern is acceleration, not reversal. China increased gold reserves by 16% in 2023. Russia expanded holdings by 21%. Turkey added 45% to the central bank gold stocks. These aren't modest portfolio adjustments. These are strategic repositioning operations that suggest monetary system transformation rather than monetary system maintenance. Meanwhile, Western central banks maintain official positions that gold serves no monetary function in modern systems. Federal Reserve communications consistently describe gold as legacy asset with no relevance to contemporary monetary policy. European central bank officials regularly dismiss gold price movements as speculative activity without monetary significance. But actions reveal different priorities. Central bank gold purchases reached record levels while official communications minimize gold's monetary relevance. The disconnect between stated policy and actual behavior suggests private understanding differs from public messaging. This often happens before systemic transitions. Institutions maintain public confidence in existing systems while privately preparing for alternative arrangements, not deception. Risk management. Official acknowledgement of systemic fragility would accelerate the fragility being managed. Silver's industrial deficit adds complexity that gold doesn't face. Gold accumulates in vaults where it remains available for monetary purposes indefinitely. Silver disappears into industrial applications where it cannot be recovered economically. Every solar panel installation permanently removes silver from potential monetary use. Every electronic device manufactured consumes silver that won't return to markets. Every year of industrial deficit reduces silver availability for monetary purposes. If monetary confidence continues deteriorating and citizens increase physical metal purchases, silver's limited availability will create price pressures that gold's abundant stockpiles can absorb more gradually. Historical precedent suggests this creates monetary policy complications that central banks cannot address through interest rate adjustments alone. When Rome faced silver shortages during military expansion in the 3rd century, Emperors initially responded by reducing silver content in coins while maintaining face values. Citizens accepted debased currency temporarily because imperial authority seemed permanent and alternatives weren't immediately available. But markets eventually recognized that coins contained less silver than official weights proclaimed. Merchants began testing coins with acid. Prices adjusted to reflect actual silver content rather than stated silver content. Citizens demanded multiple debased coins to equal one original coin in transactions. Imperial response was predictable. Decreed that debased coins held identical value to original coins. Punishment for citizens who refused debased currency. Price controls that mandated original prices despite currency debasement. These measures accelerated economic collapse rather than preventing it. Black markets developed where actual silver traded at market-determined prices. Official commerce contracted as citizens avoided controlled markets. Barter replaced currency in regions where imperial enforcement was limited. The monetary system designed to facilitate trade became an obstacle to trade. Currency intended to store value became a mechanism for transferring value from citizens to treasury. Money stopped functioning as money. Modern central banks face identical dynamics with different tools. They can create unlimited quantities of digital currency, but they cannot create unlimited quantities of confidence in digital currency. They can control interest rates, but they cannot control citizen preference for assets that government cannot produce in unlimited quantities. When confidence in unlimited currency creation begins fracturing, citizens historically shift toward assets with natural supply limitations. Gold, silver, real estate, commodities, productive businesses, anything that government cannot produce through monetary policy. Central bank gold purchases suggest this shift is beginning among institutions responsible for monetary policy, not crisis response. Preparation for transition that monetary officials see developing gradually. The Weimar Republic attempted to solve fiscal problems through currency creation in 1923. Printing presses worked continuously. Money supply expanded exponentially. Citizens initially accepted new currency because government authority seemed permanent and alternatives weren't immediately available. But markets recognized that currency creation exceeded economic production. Prices adjusted to reflect actual currency abundance rather than stated currency value. Citizens demanded wheelbarrows full of marks for bread purchases that previously required single bills. The monetary system that had functioned for generations collapsed within months, not because external enemies attacked it, because internal optimization had replaced substance with promises that mathematics eventually made worthless. Similar patterns emerged in Argentina during the 1980s, Venezuela during the 2010s, Zimbabwe during the 2000s, Turkey and Pakistan more recently. The details vary. The sequence remains identical. Currency creation exceeds citizen tolerance. Confidence evaporates. Alternative stores of value replace official currency. Metal always emerges as the final alternative because metal cannot be created through policy decisions. Gold and silver exist in fixed quantities that require mining and refining. Their scarcity is mathematical rather than political. Their value is physical rather than promissory. This is why central banks are stockpiling gold while simultaneously developing digital currencies. They understand that digital systems require confidence backing that only physical assets can provide. Digital efficiency requires metal credibility. The combination is strategic. Digital systems for transaction convenience. Metal reserves for confidence maintenance. Citizens use digital currency for daily commerce. Central banks hold gold reserves to ensure digital currency maintains exchange value. But this arrangement requires careful balance. Too much digital currency creation relative to metal reserves destroys confidence in both systems. Too little digital currency creation relative to economic needs constrains economic growth. Central banks must calibrate currency creation to maintain confidence without limiting growth. The calibration becomes increasingly difficult as economic stresses multiply. Government spending requirements increase. Tax revenue growth slows. Debt service costs rise. Social obligations expand. Military expenses climb. Infrastructure needs accumulate. Each pressure creates demand for currency creation that exceeds metal backing capacity. Central banks can accommodate some pressures without triggering confidence loss. But accumulated pressures eventually exceed accommodation capacity. When that threshold is crossed, confidence begins eroding regardless of metal reserves. Citizens recognize that future currency creation will exceed metal backing, even if current ratios appear sustainable. Forward-looking markets price in future instability before current instability becomes visible. The question isn't whether confidence in unlimited currency creation will eventually fail. History suggests it always fails eventually. The question is timing and transition management. Central banks buying record gold quantities while issuing digital currencies suggests they expect transition sooner rather than later, not immediate collapse. Managed decline from current arrangements toward metal-backed alternatives that restore monetary confidence. Citizens who understand monetary history and position accordingly will preserve purchasing power as confidence in paper promises deteriorates. Citizens who assume current arrangements continue indefinitely will discover that assumption was expensive when mathematical reality replaces monetary fiction. The metal warning isn't about investment returns. It's about monetary system transition that transforms the foundation of economic calculation. Central banks are preparing. The question is whether you understand why they're preparing and what their preparation suggests about timing. When promises start requiring metal backing again, the transition happens faster than gradual preparation allows. The pattern remains constant across centuries and continents. Confidence in promises eventually requires substance. When substance becomes scarce, substance becomes valuable. When substance becomes valuable, promises become worthless. Central banks buying 1,037 tons of gold in 1 quarter aren't making investment decisions. They're preparing for monetary reality that mathematics makes inevitable. The metal warning has been issued. The only question is whether people recognize warnings before they become requirements.